leading politics or the economy, or does the economy drive the politics, or from the cart or from the horse? We discovered in the time of Corona, the horse and its carriage are led by human health. So that's a quotation from His Excellency Sheikh Mohammed bin Rashid Al Maktoum. I think this just would give us an angle of vision that every decision maker is looking at this big change. I think we are in new normal. How can we define this new normal? How can we think about the future of globalization, future of the financial fiscal system, Bretton Woods, what's left of it? Lots of questions here are there, and the role of the state, the role of big companies, the role of small and medium business, which will be very much paying lots of price in this big crisis. So, this being said, I will leave the floor to Mario.
Thank you, Dr. Samir. We'll just have to share with you the presentation, just a few slides, nothing more. Just to sort of start guiding, I hope I don't come as too negative or pessimist. That's not my objective, of course. And as a matter of fact, I think we are seeing a lot of that pessimism playing out in a few markets.
Sorry, Mario, to interview. Dr. Raed and Mr. Plummer, could you please turn off the mics, please?
Mine was off anyway.
Okay. Mario is on. Thank you so much.
Thank you, Tabit. As I was saying, I think we are seeing that pessimistic force, a powerful force, come from there, and there are ramifications in multiple areas. Some of them have technical reasons for being there, and some others instead are more related to behavioral than anything else. What we know for sure is that this crisis is like no other, as someone has started to say also over the last week and a half. And it's like no other, at least that I have experienced in my relatively young life. But in general, they're very different from the others for a few reasons. The first one being that, for instance, the speed and the rate of destruction, economic destruction, is much higher in this sense. We'll see later some unemployment data that shows how we reach numbers that usually took much more time to be there to create this damage in the US economy, the European economy, and Asian economy too. The other one is that this time is not so much the virus that is creating the damage, if we really see it in depth. It's more the policy decisions that have been taken to prevent the spread of the very same virus that are creating. We are, as I think it was Krugman that said this, we are putting the economy as a patient in a coma, and then we are feeding it with economic resources to maintaining it alive. And in a different way, when it was the case with the influenza, with the Spanish flu, at that time, it was incredibly painful for human beings, and the loss of lives was incredible. At the same time, big politics wasn't really caring so much about it. So the virus wasn't really at the forefront of it. What we know for sure, and this is data from the IMF, underlined that every projection right now of the IMF starts from the baseline of a recovery of the economy in 2021, particularly because the idea is that we will be able to rein on the spread of the virus in the next 6 months or so. 90% of the world economy, so the countries, we see a GDP per capita growth, a negative GDP per capita growth, which is a clear sign of recession. At the same time, as I was saying before, jobless claims in the US have been skyrocketing. In just the first 3 months, in the first 3 weeks, of this crisis, the jobless claims in the US surpassed the level of the jobless claims in the first 18 months of the Great Depression. And this number, unfortunately, doesn't look to be going down particularly at a fast rate. Unfortunately, in multiple ways, this is happening everywhere in the world. And I would say, I don't want to banalize it, but it's a bit of just an arithmetic of sorts. We have a lot of workers at risk. This is data from International Labour Organization, and that says that around 1 billion workers around the world are at risk of this. The attack of this virus on the position of the service sector everywhere in the world are huge. And of course, America's Central and European Asia are particularly affected by this, but as you can see, also other countries and so on. And I was saying a bit arithmetic in a way, because, well, until we are not able to find a medical or logistic solution to face this problem, we will see still workers out of a job since there is no activity in the economy. Sometimes it's quite difficult to understand. It has been quite difficult to understand the exact magnitude of this effect. We have anecdotal data more than anything else, and now some concrete and hard data is coming. Of course, China is the first one of having it. We have seen high velocity indicators showing a drastic drop in everything of the economies around the world. But now we have some data from China. I was actually expecting a larger drop in GDP from China, and the Chinese data, of course, namely its lack of transparency sometimes. However, it makes sense that the gross domestic product growth has been negative for just 6.7% since industry, and particularly the industry textile and other sectors have been up and running, which of course helps in the calculation of GDP since it's output-based. However, we see the data coming from GDP and others from China. They show what other countries will have to face, which is a dramatic drop in consumption and a dramatic drop in retail and wholesale sales. Of course, these are and bring up some problematic situations also for China, and particularly namely for the recovery and the speed of the recovery of the country, which will be valid for every other country, as a matter of fact. External demand is quite low, considering that the rest of the world has shut down and is in a lockdown, and as such, the speed of recovery will be quite lower. And as a matter of fact, and this is a problem for the rest of the world, China will not be the shiny, with its shiny armor recovering the rest of the world like it did in 2008, considering the dramatic level of unproductive debt, etc. Going to the annual change in volume of war merchandise trade, I'm sure that Dr. Plummer will have a lot to say about this in his intervention, so I will just briefly speak about it. But the reduction that WTO sees in merchandise trade is about 32% in year on year, which is quite relevant. And of course, they are also speaking about the fact that we are able to solve this problem. Today's data from South Korea indicate a drop month to month of 27%, which is quite impressive. But on this topic, it's quite interesting to see and discover, for instance, that WTO, as we know, doesn't speak about services. But if we check the services, it's very hard to calculate them. Well, it's very interesting to see how digital is growing, how all this area of trade is growing, and I'm very curious to know from Mike where this could go and where this could lead for other countries, such as the UAE, such as African countries, such as all those countries that maybe were not the UAE in that case, but like, let's say, African countries were lagging behind on digitalization and all the MENA in general, and now this could instead be a new engine of growth. When we go to oil, of course, it's impossible not to talk about what happened yesterday with the future and the contracts in WTI plunging at incredible speed in less than 2 minutes, I believe, and the numbers that turn negative. This is easily explained in a way, if you want to put it this way, but in a nutshell, the cut of supply from OPEC Plus, however historical that decision was, is just 9.7 million barrels per day. And we are talking about 25 to 35 million drop in demand. So that's quite relatively easy to see that situation. Of course, this is an incredible panic attack of the market, if you want to put it that way, but stock space is decreasing incredibly. It will be very interesting to see how shale oil and others react. On this point, it's also very interesting, and it's something that I'm sure that Mr. Cantelmi, Christopher, will speak about how this will affect development in energy, and particularly how this will affect new energy forms, as the Chinese used to define them. And of course, this is a one-two punch of incredible dimensions for emerging markets and frontier markets and poor countries that have based per years their development on oil prices. Of course, this creates a huge problem that goes together with deficit expansion and an incredible deficit expansion that we are seeing around the world. However, I will distinguish a bit in this, and I'm sure that Dr. Safadi will have a lot to say, and of course also Mr. Hong on this, on how infrastructure develops. But I would say that we have two different pictures right now. On the one hand, a G7 story. A G7 story in which we have countries that are throwing literally the kitchen sinks to the crisis and are putting a huge amount of resources in this. In a way, we can say that this is a silver lining of the so-called secular stagnation theory, with brave and unrestrained decision-making and unrestrained by inflation fears, which, if for what it's worth, I agree that we shouldn't be afraid of inflation right now. But we are seeing that explosion, and there is no way that deficit expansion and overall fiscal balance will be affected. There is a lot of talk around the monetization. I do believe that there is a bit of confusion on the topic, and maybe we can also talk about this in the future. For certain, what we have experienced until now is that an exogenous shock that, of course, accelerates all the process of endogenous problems. And one of them was the so-called Japanization of the economy. And we are seeing that happening under our eyes. And as everyone knows, the Bank of Japan has a balance sheet of 101% of the economy. We are seeing the Fed increasing dramatically its economy. In a way, the ECB is moving in the same direction. However, I do believe that the intervention, particularly if we look at the numbers in the US, have it a bit backwards. And I'm sure that Dr. Safadi on this will have a lot to say. In my opinion, the main concept, this is a medical issue, it's a public health issue. As such, the main part of the money should go to solve that problem, because if not, we are not really solving it. Instead, if we go and see the 2.2 trillion fiscal package, the first part of fiscal package in the United States, we discovered that only 180 billion are directed to public health, which sort of looks like it's backward. At the same time, we have emerging markets, and of course, they are suffering from this. The G seems they have been suffering from an incredible outflow of capital before, pressure on their currencies, and so on. And in this sense, the decision of the G20, frankly, has been a bit underwhelming. While it's true that they decided to grant repayment, a delayed repayment on debt for just until the end of the year, there is no real support and money coming in for emerging markets, frontier markets, and poor markets that then are in a very difficult situation. They need to solve the public health care system problem and at the same time revive their economy, which is very complicated. I will finish with just one mention, and I really hope to talk about this too in the future. I do believe that all of this will create in the future a political problem. Meaning that if we had problems in 2008 with people saying that the central banks and politics were saving only the 1%, now the Fed is actually supporting private equity directly, which is extremely important right now. But of course, we are saving people, if you want to put it this way, in the street world that are making billions out of that. So I do believe that that could be a problem going forward when we talk in a second phase, what countries will do right now. And speaking about markets, I do believe that this will lead to even more market concentration, more income inequality, and those are certainly issues that we should focus on in the future of research. We'll stop here. I will stop here, and I'll give back the microphone to Dr. Samir. Thank you. Dr. Samir, you're mute.
I'm sorry. Yeah, that's always my problem.
Yes, you are on, Dr. Samir.
Yes, thank you very much. I would leave it to you, Mario, to guide this session because you may know better than me which one would be speaking, etc. The sequence of the intervention would be better led by you.
Sure. Then why don't we start with Dr. Plummer? Mike, word to you, and on trade and specifics on that. Thank you.
Okay, certainly. Can you hear me? Am I unmuted?
No, it's perfect. It works.
Okay, great. All right. So I was asked to talk a bit more about the effects on trade and what the future might hold. I think that Mario did an excellent job of giving a tour d'horizon of what's going on. It was a bit bleak, but it's very difficult to be too optimistic in this current environment. But I guess the first thing I would say would be that when economic prospects are bleak, that trade prospects are as well. And I would delineate three channels through which this would be the case. The first would simply be a direct effect. That would be lower incomes would lead to lower trade. A second implication would be the fact that uncertainty of the situation will affect investment, and particularly foreign direct investment. And as we know, there's a very close link between foreign direct investment and trade. And a third channel would be a combination of the two, where, whenever we have economic contractions, that the resulting uncertainty will lead to protectionism, which has obviously a negative feedback effect on trade. So let me just quickly organize my thoughts around these different channels. On the direct effects, obviously it's going to depend very much on what the extent of the negative income effect is going to be. I guess I'm less optimistic about the predictions of the IMF and the Asian Development Bank, for example, about a rebound next year. They are both forecasting a very large recovery next year. I don't think it's going to be as sharp, but certainly there will be a rebound, I think, next year. And a lot of some of the, political analysis, et cetera, seems to suggest that this could be, the end of the global liberal order, and just like they did with the 2007 and 2009 crisis. And I think those things are exaggerated. However, I do believe that we'd be probably naive to think that next year we're going to have a very, very quick recovery. The Asian Development Bank, for example, predicted that China will grow by 2.2% this year, and then grow by over 6% next year. I don't think that the rebound will be that strong, but it's going to be coming. Now, what has helped is the massive interventions around the world that Mario mentioned have been, I think, very appropriate for the current situation. Central banks have been very, expansionary, and as Mario mentioned, not just buying, bonds, but also going into other types of securities. The U.S. has been particularly aggressive in this regard, but Europe has interesting set of packages on the way, and China, no doubt as well, even though, as Mario mentioned, China is a little bit gun shy from what happened during the recent, from the 2007-2009 crisis, when it went really quite overboard and was suffering with the high debt consequences after that. So we'll see how that pans out. But of course, remember that these things take a while to go through the system. Fiscal policy does not work overnight. As a matter of fact, it takes a while for these things to have an effect on the economy. So I think that these the deep drop in growth that we're talking about over the short run, I think is probably well justified. in looking at the WTO data and the pessimistic scenario, a drop of 32%, I think is probably too pessimistic, but we are going to see a drop. And in a way, this is going to be cushioned to some degree by the change in services trade. As Mario mentioned, we're becoming much more used to digital services. We're consuming them much more. And I think that when I look back over the last 5 years and some of the negative impressions of trade, et cetera, and what its effects on job disruption and these things have been quite exaggerated compared to the changes due to the arrival of the digital economy. And I think that's actually going to increase. So I think we're going to see much more services trade. We've now got more infrastructure for that. We're not only have the effect of reducing the trade shock in the short run, but also will have important long run effects. So we're having, if you will, a kind of a hysteresis or beachhead effect that is going forward. Okay, so that's the direct effect, which are going to be important. But the second effect, uncertainty, was actually in evidence before COVID. We don't talk about it much anymore, but we had the US-China trade war, which was disrupting markets a great deal. We had a bloc World Trade Organization that was creating uncertainty, and certainly populism is not dead. So trade was already being hit by these effects, and the key problem, of course, was the fact that the United States, which really was so instrumental in developing the post-war liberal global international model, was actually on the sidelines. And when the new administration came in and was trumpeting the fact that protectionism leads to prosperity. And so what you saw is the leader of the global economy that was now actually advocating a completely different model. And this was leading to a great deal of uncertainty. And this has had an effect on domestic investment, and it's also had an effect on foreign direct investment, which, as I mentioned before, has a close link to trade. Global supply chains were changing before COVID. And even before the US-China trade war, it's just the US-China trade war expedited the changes in supply chains. I think COVID is also working to lead to greater reorganization of these supply chains. But it's not clear to me that this means that everything is going to become national again rather than regional or global, as some people are predicting. I think we're seeing this in the short term, but I'm personally more confident in the long term that this will not prevail, because it is not clear to me, and I do not think there's any empirical evidence that would suggest that national supply chains should be more stable than regional or global ones. And I think we're seeing a temporary effect in this regard, but I don't see that as being a long-run threat to the system. It's always hard to say what the future is going to hold, and perhaps it reflects my own biases, but I think that how things are going to play out in part is going to be a function of what happens in the United States in November in terms of elections. The elections would normally be in the front pages every day of US and foreign papers. They have been completely sidelined, but I think this election is going to be very important going forward in terms of what it means for uncertainty and greater stability in the system. And a new administration, I think, would lead to greater certainty in that regard. And that would lead me to the third effect on the economic shock and protectionism. As you know, crises always lead for greater cries of protectionism. And there was a great deal of restraint, I would say, in the recent global financial crisis, 2007, 2009. Every major meeting of leaders in the global economy would end with a statement that we're going to try to resist protectionism. And that was a big priority at the time. This crisis would be no exception in that it is leading for greater cries for protectionism, but I guess we would add to it some of the sector-specific problems that need to be dealt with added onto this, and that would have to do with health-related items and so forth. And even within the EU, we've had a reaction, a nationalist reaction, to even restrict the exports of some of these products. So that tends to be a big threat. And if the idea of national security is broadened sufficiently, it can essentially cover everything. At one point, it seemed as though the Trump administration was defining national security as being jobs. And so if any job is at risk, we need to protect it. If that is the case, then we actually are going to be hitting at the very concept of gains for trade, and that is going to be a big problem, because if all health items need to be produced domestically, why not all food, which obviously also has an effect on health? And then if that's the case, what about manufacturing? We need to, manufacture ventilators and these sorts of things. If we don't have a better approach at dealing with these issues, I think it's going to be a problem. And also techno-nationalism is part of that issue. And it was important before COVID. It will be even a bigger one afterwards. So I think this is a critical issue that it needs to be dealt with in the future. And I think we're adding to this the idea that this social distancing, as we've been talking about in every economy, it seems to be leading to national distancing. And that immigration is also taking a big hit, and it's relevant to trade. And I saw this morning, for example, in the United States, the Trump administration is going to try to put a hold on any new green cards, and a very severe hold on immigration. And I think that's a mistake. First of all, it doesn't help us in the crisis, and second of all, it gives the wrong message. So just giving some prospects. I'm confident in the ability of global markets to adjust to these shocks. I think that governments will either facilitate that adjustment or slow it down. And from current trends, it looks like it's a mixed bag. There's some signs of facilitation, but there's also some signs of blockage. So what's clear to me is that more than ever, international cooperation is important going forward. And like it or not, we're all becoming more interdependent. And so that we need to govern ourselves from a global perspective, something that we haven't really done that well in recent years at a critical time. And as everybody knows here, the WTO, the last successful single undertaking at the multilateral level under what is now the global, the WTO, really hasn't made any progress since the mid-1990s when the Uruguay round began implementation. We haven't had any serious changes, and that was in 1995 when that started. When the global economy was very, very different. So we need new global rules that are applicable to crisis periods, and we need therefore to have better means of cooperation at all levels, be they global, regional, sub-regional. I'll stop here.
Thank you, Mike. Very interesting. We actually already received a few questions about what you said, so we'll go back on that. Christopher, why don't you take it from here and you show a bit of your take.
Hi, thanks, Mario and Mike. Great to see all of you here on the forum. As Mario introduced, I'm on the IFC, a principal on the infrastructure team here in Dubai. I'm more of a finance practitioner than an economist, but I feel that we can all talk about a little bit of the trends that we're seeing in the region. So from Dubai, we typically cover the Middle East, North Africa, and also the Horn of Africa. These are the countries that we're specialized in. We have quite a large portfolio of renewable energy projects and thermal power, well, not that many thermal power projects, but renewable energy projects in Jordan, Egypt, Palestine, and increasing in other markets as markets open up. This tender recently in Tunisia and places. We don't work that much in the GCC because of the wealth here, but gives us a good idea of what's going on in the developing Middle East markets. The effects of COVID on the markets, I think we see them most profoundly at the moment in terms of the claims for force majeure. So, I mean, I guess there's two things we want to talk about. One is an overall view of the effects on the energy markets. We don't do as much in the petroleum sector, fossil fuels, as we used to in the past. But generally speaking, we see the, a dramatic upheaval in the markets, in the oil markets that everybody's aware of. You see negative oil prices for deliveries in Texas this month, due mainly to the oversupply of the bunkering facilities, places that there's no place to store the deliveries coming on, and traders are having to offload these contracts before they have to take physical deliveries, which has resulted for the first time in history in negative commodity prices. Mainly reflecting the cost of storage in Texas. But this is obviously going to have a dramatic effect in the way we view energy going forward, and on the way that countries strategically think about how the interconnection between conventional petroleum, petrochemicals will be implemented in the world versus the rising use of renewable energy. I think there's two forces here. I mean, one, there's a glut of oil in the market, and when industrial production picks up again, we'll see that that will gradually pick up the slack, although the backlog could be quite a long time before there's balance restored in the markets. There's also been caught up in a bit of a tussle between diverging policies in oil cartels, which has also contributed to oversupply at the same time. There's been a dramatic fall in demand. These may clear. I mean, one force obviously is that the cheaper the crude oil is, the more likely people will be picking up the use of it again once their economy recovers. And that would be a force against the move towards renewable and clean technologies. However, on the other hand, with the definite positive effects on the environment that we've seen in the last couple of months, where people are locked up and industrial production has been shut down, and people finally can start breathing again in Delhi and other overpolluted cities, and where people have forgotten what it's like to breathe clean air. There may be a force, if it's seized upon at this time, to push towards technology and towards renewable energies, at least, or at least also in terms of investing some of this excess savings in terms of cleaning technologies, scrubbing technologies, to be able to have better environmental conditions going forward. Hard to say. That's on my perspective on the global energy perspective. With regard to what we're seeing on the ground as a bank, at the IFC, when COVID first started, the initial effects were very little of the projects that we have. We have probably about 20 or 30 energy projects in the region. Projects under construction started getting notices from suppliers in China that they were not able to make deliveries of critical equipment. These have been dealt with and we're working their way through the system and the normal force majeure procedures. And I think as China has started to open up again, those pressures have come off. But what we really see now, which is a bit much more alarming, is that on the other side of the equation, we're finding off-takers, which are usually state-owned utilities, have been also filing force majeure notices is that they are having economic difficulties because of the fall in demand of electricity and therefore a great reduction in their collections. Usually one of their best paying clients is the industrial sector of their countries, which usually cross-subsidize other areas of the economy, particularly homeowners and poor. And these are the ones who were the worst hit, and therefore are no longer consuming electricity, and therefore the state off-takers are suffering from this. So, across the world where we have where we have investments and where our clients have investments, we're seeing the effects mainly on the off-takers being able to cope with this. Now, the World Bank and IFC, as well as a lot of almost all of the DFI and multilateral community, we've all been trying to do as much as we possibly can. We have special facilities that we're rolling out to help our clients to cope with the next 6 to 9 months of cash flow disruptions. And we're trying to identify the best places to put these together. I think IFC alone has announced 2 to 8, the number keeps changing, but it was initially 2 billion in this type of COVID support for our clients. I believe the number is increasing. This program of working capital facilities is being rolled out. At the same time, we're working together with the World Bank to see what kind of support we can give to those countries that are facing difficulties. It's still a very fluid and dynamic situation. But definitely, one of the upticks of this whole crisis is the way that the international community has come together, at least the multilateral side, and in terms of putting together support and relief stimulus to help countries and economies and clients and companies weather through the storm. So that's my take on things for now. So I'll turn back over to you, Mario.
Thank you, Christopher. I have a couple of questions on how multilaterals can actually support the situation, given what we are seeing in the various negotiations in the last few weeks. Let's turn to Mr. Hong. To speaking a bit more from World Bank, infrastructure analyst, maybe to focus on that, on the infrastructural side and on the effects, of course, for the next, for Safadi intervention on the debt situation, how governments can manage this. Thank you.
Okay, can you see my presentation?
We can, yes.
Okay, cool. So I just start from here. So again, just to introduce myself, I'm Seong from World Bank, and I primarily focus on managing a product called PPI database. It's called Private Participation in Infrastructure Database, and its purpose is to identify and disseminate information on private participation in infrastructure project in low middle-income countries only. So just like Christopher, we have more expertise in developing countries. And in short, making long story short, we are basically what we do is we track all infrastructure spending commitment in developing countries at project level. So we can run various types of analysis based on this PPI database. And today I just want to briefly talk about preliminary findings from it in context of COVID-19. So as we all know, COVID-19 crisis poses a potential threat to financial stability of different countries. And it's going to be worse for developing countries with weak governance environment. For many developing countries, infrastructure accounts for majority of government spending. And take Laos as an example. It's an extreme example, but it's a fun one. GDP was 18 billion in 2018, but single railway project sponsored by China was 7 billion. So 40% of GDP was actually designated to one project. I'm not just saying that this Laos government would pay the 7 billion at once, but I'm just trying to show the level of liability that it has in its balance sheet over time. So in COVID-19 situation, budget deficits will be impacted by government spending, and failure to pay back to all these private sector infrastructure projects may deteriorate the fiscal stability in the future. In the consequence, it will also impact on planned infrastructure projects, which will have impact on projected growth. So today, I just want to show you what regions and countries are more exposed to this financial burden and obligations originated from this infrastructure project that they had committed over last 20 years. So using PPI database, we were able to calculate cumulative PPP investment by different region and country. As you can see from the graph, on the left side, we see Latin America. I mean, in absolute term, the red bar is in absolute term, and the line shows is the PPP exposure in terms of their GDP in 2018. As you can see, Latin America, East Asia, and South Asia are the regions with higher exposure to PPPs and infrastructure in general, in absolute term. As a percentage of regional GDP, Latin America is still the region with the largest exposure to PPP, followed by South Asia and Europe, Central Asia. And I'm talking about all developing countries only. So despite its high value in absolute terms, East Asia exposure to PPP in terms of GDP is still lowest among 6 regions due to high regional GDP, mainly represented by China. And there's why we set analysis only to cumulative investment of last 20 years. Most of these contracts are well over 10 years, as you can imagine, in duration. So earlier PPP remain relevant as a fiscal risk. So in fact, most of independent power producers, our contracts are around 20 years. So that's why we try to set this cumulative PPP in 20 years. In Latin America, the PPP investment were led mainly by Brazil, which accounted for 65% of regional infrastructure investment. Unlike other regions, PPP investment in Latin America peaked in 2012 and 2014. As you can imagine, this is partly explained by Brazil's race to meet World Cup and Olympic Games deadline. And one thing to note is that the government-owned Brazilian Development Bank, namely BNDES, played a key role in financing all this infrastructure project, which is more concerning from fiscal stability point of view. So other countries in Latin America include Mexico, Peru, Colombia, and Argentina. They're the followers. And this is at country level. Look at this country level in absolute terms. So as you can see, India has been the leader on toll road and IPPs, followed by China and Brazil. Please note that there are 4 countries from EAP in top 10 countries with largest exposure to IPP. IPP meaning independent power producers. The countries are Indonesia, China, Thailand, and Philippines in decreasing order. And it can be a bigger point of concern for Indonesia, Philippines, Thailand compared to China because their GDP level is much lower, but their absolute level is big. So this is the table that I developed. Of course, Laos is at the top, like I choose as an example. It's an extreme case. These issues will be particularly serious in countries in weak governance environments, just like I said in the first part. In this context, it may be interesting to do post-plot cumulative PPP exposure as a percentage of GDP. So although it is small in absolute term, Laos' exposure to PPP as a percentage GDP is the highest at 125%. In addition to high exposure, like Laos exposure is struggling with problems at indebted power utility called EDL. And following countries are Jordan, Djibouti, Jamaica. These are all small countries. So in terms of GDP, their exposure to PPP is high. But also take a look at Brazil, which is at 4th. At individual country level, Brazil is only a country that has high level both in absolute terms and as a percent of GDP. So in addition to retrospective data, World Bank is also working on collecting real-time data on infrastructure projects to see ongoing impact of COVID-19. So as of April 16, which is last week, there were already 25 infrastructure projects that are delayed due to COVID outbreak. And the main reason for this delay, as we are entering the early phase of the impact, is halted supply chains and skilled labor inflows from China. Majority of these delayed projects are located in East Asia, probably due to the regional proximity, and South Asia. Based on information, total estimated project cost of these 25 projects are 25.6 billion. And what I'm saying is, as we are entering in April, we are already seeing the impacts from infrastructure side. In the early stage of the outbreak, again, Indonesia is one of the countries that are affected the most. Indonesia just reported that delayed of completion of 11 large-sized coal-fired power project. The main reason for this is probably the situation in Indonesia is particularly acute because China and South Korea, both of which are coronavirus hotspots for now, are major backers of Indonesian coal plants. Some other market development in infrastructure perspective is in EAP, Cambodian government delays all construction projects to fund coronavirus fight, which will also postpone all their economic planning for next year. In South Asia, a series of private sponsored court has declared force majeure. All passenger train services across Pakistan and India are suspended. And Nepal stops payment of independent power producer. This is a big deal because it might indicate the total cut of power coming years. To sum up, I just want to re-emphasize that for many developing countries, infrastructure spending consists of a majority of government budget, and it makes sense to distinguish and focus on those countries with high exposure for now. And it also indicates where the next tornado might come from. So disruptions due to ongoing COVID also have an impact on planned infrastructure projects, which will have impact of future growth in developing region. And this is where I just want to wrap up. Thank you.
Thank you, Seong. This leads, of course, to a lot of questions about how those infrastructure are sustainable. And I will lead to, and probably it's a perfect introduction also for Dr. Safadi, and they will speak about government role and as a manager of last resort in a crisis. So please.
Good morning, ladies and gentlemen. Another 10 minutes and I would have said good afternoon. But we've been hearing a lot that these are exceptional times leading to exceptional measures. I will define from my own point of view and in the present context what exceptional times mean and what exceptional measures mean. Exceptional times are today with us because we are for the first time faced with the premise that, with the dichotomy, save the economy or save lives. This is now a question before every government around the world. Exceptional measures. Hello, yes, you can hear me?
Yes, we can.
Exceptional measures only maybe to the extent that we are deploying the traditional measures in such volume, in such depth, that we've now haven't done it before. Which, in a nutshell, leads me to talk about pandemic economics. There's nothing special about pandemic economics to the extent that we know the traditional measures work, and now the dichotomy between saving lives or saving the economy is a false dichotomy. Someone is saying hello, so I don't know. Please shut you, just to avoid any distractions. Anyway, so now we're faced with the question: opening the economy too soon produces mass death, but shutting it down long produces mass sufferings and pain. So premise number one, what is this? What's happening now? Premise number one, economy will suffer more if severe lockdown are not instituted. Second premise, severe lockdowns produce human misery with millions of unemployed, bankruptcies, and financial anguish. Do we have any experience with early and aggressive interventions? Do they save lives? Do they trigger faster rebound? These are questions that I will leave to the pandemic economics to be developed. Hopefully, Michael, you'll start a new course at Johns Hopkins called Pandemic Economics. Now, pandemics are so destructive, as far as I'm concerned, that anything you can do to mitigate its impact is going to be useful. This is my first premise, the starting point of all the decisions that need to be made as we move to normalize, whatever that word means. Without a healthy population, there cannot be a healthy economy. So, what needs to be done? I jotted down some thoughts that will prove to you that these are still not exceptional measures, but they are your traditional intervention measures when faced, for example, with a recession. First thing you do, you want to boost demand. Then you ask yourself from a government perspective, is it actually the time for me to open up all restaurants, fill it up to capacity so that people will be happy, and then I face the risk on the pandemic front? So it's a very valid question. This is the extent to which this pandemic economics actually will need to argue the wisdom of this kind of intervention. So, pay people to stop working, is that unconventional? Is this exceptional? I submit to you, it is not, right? So you need to first have a minimum social infrastructure to support people as you lock them down. Basically, what we're talking about is, locking down the economy, this false dichotomy that everyone is talking about, right? On the one hand, that you want to lock down the economy, right? So you test the health of people, the mental health of people, and you test the health of the economy against, the risk of a pandemic or a spread. So pay people to stop working is a good idea, and it has been instituted to the different levels across the world. Mario, you talked about putting the economy in an artificial coma. It is the case. It is what all governments today have been called upon to do, and it is the right thing to do. Now you put it on, you induce a coma, but you make sure that you have it in intensive care so you don't kill the patient. That is the kind of a balance that we're trying to do. It's not a dichotomy, saving lives or saving the economy. They both work together. Remember, a healthy economy needs healthy population. Both go hand in hand. It's not a dichotomy, right? Now, pay people to stop working. Second, what I heard in different fora, build a time machine for companies, and especially for SMEs. What does that translate to, right? So all the liabilities, the loans, that repayments that the SMEs have to honor on a regular, in a normal situation, their wage bill, their operational costs, and all this, right? All these, find a way to defer them 3 months, 6 months into the future, and that is a wise thing to do, and that is what is happening. Not just in the US or in Europe, but also within the GCC context, right? So build that time machine. It's only a matter of time. And then here's your third pillar. Clear the way for your health workers and your scientists to deal with this pandemic issue, right? So we're not in a race here, Politically, yes, people can talk about it, open, not open, and then elections, no elections, I don't know what, right? But in reality, we need to clear the way for the health workers to do their jobs, for the scientists to do their jobs, while the economists also do their jobs in trying to keep the economy on life support system, right? Pay workers, and then build that time machine for companies. And that is my introductory remarks, and I leave it to you to challenge me on any one of these. But I still call on Michael to think about creating or building a course in Johns Hopkins called under the title Pandemic Economics.
Thank you, Dr. Safadi. I think that's a very good idea, actually. I think a lot of universities will move in that direction. Let's start with the questions, and actually we'll start with you, Dr. Safadi, since you kind of wrapped up all the presentation before. I completely agree with you about this false trade-off about public health and economy. You cannot have a healthy economy with an healthy public system in that sense of people feeling sick. At the same time, can you go a bit more in depth on what are the activities, the practical activities the states are doing, maybe also here in your experience directly in Dubai, and how this will provide support to the entirety of the system? And particularly, what is the plan if this continues, of course, and this, of course, it's more for countries maybe with bigger populations and with larger difficulties in scaling up the test and so on. Thank you.
Thank you, Mario. I go back to my three premises, right? Pay people to stop working, build the time machine, and clear the path for health workers, and scientists to do their jobs, right? Operating in an environment of uncertainty towards where is the end of this crisis. So what do? The first thing you tell yourself, I do not want to front load all my measures, all my instruments, because I don't know the length, and therefore I'm going to go step by step, ensure survival. The induced coma, right, within a limit that we need to keep controlling. And I'm saying this because of experience rather than a study. I studied it in your traditional textbooks, right? So pay workers to stop working is a critical element in the equation that has been instituted across the GCC countries. And I can only speak of those because I know, in the case of Lebanon, Syria, Egypt, the issues are completely different, and they all depend on the entry point into the coronavirus crisis for these countries that precludes instituting some of these measures, right? So what does it mean to pay workers? Shift the liability of workers, especially within the SME, especially those that are within a certain wage bracket, shift it from companies, from the SME sector to government at a certain scale. So you ensure a social stability, social infrastructure is there, right? So this is the first thing. And how you do it? You start not with the maximum, but you start creating baskets of support. And these baskets are dictated by the fact that you don't know the end date, as I say, right? So whatever you budget today may become irrelevant, next month or the month late, 1 month later. So we operate under the premise that this will be over by the 15th of May. Events may prove that, maybe 15th of June, maybe mid of July, maybe September, because also return to normal, which means that, you have a full economy, a full open economy in the transport sector, in the tourism sector, right? In the trade sector. All of this is an open question. No one has the answer today when we can safely go back to a pre-coronavirus environment where planes and passengers and cross borders and what have you. So all of this tell you that you need to plan for the worst case scenarios and don't front load all your instruments and deplete them, so that you can always bring in new measures to respond to new developments. The SME is the backbone of any economy, and it is the case also across the GCC. Packages abound for SMEs, but they start from what? From the central banks' realization that they need first a support to the financial sector to ensure that confidence remains high there, in the sense that the shares of non-performing loans, you would expect them to rise, or investors would think that they would rise, and therefore put the banks under undue pressure, right? So you need to ensure that there is a financial stability, and then the central bank comes out and says, listen, guys, there is no such thing as too big to fail or too small not to help, and all this. We will support our financial system, right? Liquidity is not an issue. We're going to go into a zero interest rate environment. We're going to go into relaxing some of the reserve requirements over the bank. We're going to go and actually relax some of the egregious, I would say, regulations against lending to SMEs that would have the pricing of risks at 20 to 25%, making those loans at close to 28 to 30% interest rate. So we're going to deal with that, right? So this is like an indirect channel whereby the central bank will try to channel funds to the SME sector via commercial, and that is something that is being done across. Now, then you go into the those SMEs, the micro SMEs that have never banked, which means that those that have never resorted to a bank to get a loan or to get their accounts and what have you. What do you do about those? And these are also, a big chunk of your economy, and therefore you need to find a way. Whereas, the regular SMEs, you find is your way to supporting them through the commercial banking sector. But for these guys, you need to go straight and identify them and channel help directly to them. So I'll leave it. And then, of course, you let, the third premise, letting your health care workers do their jobs, right? And clean up, sterilize the city, 24 hours operation, day in and day out, until this beast is defeated.
Thank you, Dr. Safadi. I'll to Michael Plummer now. I've been receiving in our email that has been created for this workshop a couple of questions, actually more. And this is something that I've noticed since I moved to Dubai. There is a lot of attention in the GCC about the nationalization of jobs, which is quite interesting. And I know that, Mike, you have certainly a position on that. The question particularly is that the trade, you mentioned that, and I'm just reading here, the trade of service, talking about the most important source of service, which is labor. Can you see countries readjusting their labor market infrastructure where priorities are for the national over migrant workers? So in a way, just to give more space, even more space and even priority to national workers. I would like for you to go, for instance, and maybe explain here. I will use your expertise as a professor to explain why this could be a problem when there are no skills, or when the skills are not particularly elevated, particularly in IT and so on, in complicated, let's say, technical aspects for now.
Okay, thanks for the question. I suppose I should address Dr. Safadi's challenge that we should have a course on pandemic economics, and I look forward to talking to him about being the instructor for that course. So maybe we can do it partially virtually and partially in person. So look forward to that. In terms of the labor question, which I think is an excellent one, I think it's important to keep in mind that this question was very applicable 6 months ago as well. I think that it's we've had a big upsurge in populism, obviously, in the West. If we look and see what happened in the UK, for example, in Brexit, a lot of the arguments for Brexit really tended to be against, immigration, and it was a real problem. I think it's going to be a real problem for the UK economy because of the fact that the UK's comparative advantage tended towards services, and a lot of those services were being provided by importing skills from immigrant labor. And of course, the United States is a country that built itself on that. So I think that that is really a problem, but it was a trend that was already in evidence, and it could, the COVID crisis could actually lead to a bit more in that direction, but I'm not completely sure about that, because I think it's pretty clear that it's really not immigrant labor that is propagating this disease, and whether or not these facts show up in the headlines is something else. But I do think it's an issue, and I do think it's a problem. And I think in a way that if we look at populism more generally, it results due to a public policy failure. And I think this is what Raed is anticipating when he talks about putting in a social infrastructure to deal with the disruption and the need to make sure that the losers are going to be compensated. It reminds me also of a project that he did really on trade called eyesight, that sort of looked at the problem with trade is, sure, it displaces labor, and yet the country gains from it. And our problem was this public policy challenge that we never really were able to compensate the losers in that process. And that needs to be a priority, just like this, providing the social infrastructure also needs to be a priority. So I think that would go a long way in reducing that argument that has been made about the problems of immigrant labor. I mean, study after study show that immigration is very positive for the economy rather than negative.
Thank you, Mike. Yeah, that's actually all very true and very well said. Dr. Safadi, you have direct experience of that question, I believe, must have come out quite a lot in your meetings. Do you have something to add on the topic?
Well, I would agree wholeheartedly with Michael. The critical aspect in here, in normal times, right, and not to negate any point I've said, you do not protect jobs. You need to protect workers, not jobs. Jobs can be destroyed and better, hopefully better jobs will be created. So you protect workers. And this is a critical element, whether to consider whether you are in a pandemic, in a normal situation, or whatever. Now, pandemics are what? They actually, not only they are, destructive force on the health and what have you, but also most importantly, or equally importantly, they bring out the vulnerabilities that are inherent in any one economy, right? So they augment it, they make it so visible. And therefore, whatever was not possible before in normal times to actually have public policy move in its direction, now you have an opportunity to say, listen, these now have become, these issues or these challenges may become a fact of life, part of planning, part of development, and therefore they are a quintessential, a pillar, in moving forward.
Yeah, I believe this will bring also up all the discussion on creating workers with better skills and education and so on and so forth, which is definitely part of the social net we were talking before. Moving on instead to what Mr. Plummer was saying, Dr. Plummer was saying, but it's in reference with what Christopher and Seong were talking about. We said of the role, of course, of the IFC and other multilateral institutions. We saw over the last week the meetings and the results of those meetings. And I am one of those who was a bit underwhelmed by the results of those. I'm not trying to put you on the spot here, so don't worry. You will not have to say anything against
your institutions. But at the same time, it's quite clear that there is a movement towards this movement towards being more isolated. The decisions that were taken in 29 and 30 in multiple ways. So countries that are closing down, and this will increase the pain. Do you, and I'm talking about Christopher and Seong, and of course I would like the idea of everyone else, including Dr. Samir, do you think that this movement can be stopped? I'm referring to this in the sense that this is an exogenous factor that is hitting an endogenous variable. So at the end, this was coming, and it was a good old time when we were only worried about Trump and the China and the Sino-American war. This has changed dramatically today. But do you see multilaterals being able to be a strong voice in favor of more integration on this? Why don't we start with Christopher?
Yeah, so the question is, was the retrenchment of the multilateral under the recent administrations, and can we reverse this? Is that correct?
Well, the question is, do you see the multilaterals able to voice the need for more integration? Let's put it that way.
Yeah, I mean, I'm a strong believer in the multilateral world. I think it's still functioning. I think there has been a change in emphasis over the past 3 years in terms of looking towards the private sector rather than stimulating the governmental sector. I think that's one of the trends that has come out there in the last couple of years. In terms of our reaction to the current crisis, I think, well, everything is relative. But relative to the world that we normally work in, where we're dealing with usually long-term infrastructure projects or things that take months or years to structure and put them into place, I think that the multilaterals have been quite quick to react. Now, in putting together a COVID facility, for example, I mean, I've been at the IFC only 7 years, but this is the fastest I've seen an initiative go through our senior management and get put into action, and it's being pushed out through every part of the IFC, and that's just us. We see our colleagues at EBRD, at the World Bank, in other DFIs across the world, also having similar pushes from their governments to be involved into and to lend as much support as possible to help ease the pain and get us through this crisis period. So I think it is moving very much in the right direction, and it's very relevant. I mean, the numbers are what they are. I mean, they're billions. We don't have trillions to throw out of the economy at IFC. I mean, collectively, that kind of money can only be done by our sponsors or our host governments. But what we can do with our own balance sheets, I think it's being pushed very aggressively. So yeah, I think so. I don't know, Seong, if you want to add something from World Bank perspective.
Thank you, Christopher. Same question of sorts for Seong, and maybe related to infrastructure, directly to infrastructure. And considering that emerging markets and frontier markets need around 2.5 trillion, and IMF, for instance, only has 1 trillion at all in its war chest, how this can affect infrastructure, how can this affect, of course, debt situations? And maybe you can go just slightly on that.
Okay, this is perfect timing because the work that I presented during today's session from my side was actually related to what you're talking about. So what we are trying to do, looking at the short-term fund from our side, we are trying to, from our VP level, we are trying to focus on those countries that has potentially high risk of infrastructure and fiscal risk coming from infrastructure. That's why my work from the first was developed. We were trying to focus on those countries with higher risk. And that's why we came up with all this real-time database, which didn't exist before COVID. As you might understand, we're trying to we're trying to respond as fast as possible because we have this reputation of being late in any actions. So that's, I mean, your question is trying to, it's kind of putting me in the spot, but what I'm trying to say is we are actually trying our best to respond to this crisis as fast as possible, trying to focus on the countries with the potential risk first, because we understand we are short of funding in terms of managing all this crisis at the same time.
Thank you. So it goes again to, of course, limited resources and the need to prioritize in that sense. We go back to what Dr. Safadi was saying in multiple ways, but at a global level. And I will ask Dr. Safadi, what is your opinion under this point of view? And this question goes also, of course, to Michael Plummer, always remaining on the same line. What is your opinion of the support of emerging markets and so on that needs so much? We are lucky, in a sense, in the UAE to have so much capital, right? It was constructed and built over the years, so the situation is much different. But what do you think if we expand that condition to other countries that maybe have managed, for instance, in a different way, in the very same GCC? What is your opinion on that? You're mute. So.
Multilateral issue, right? Listen, nationalism, isolationism, they're not making a comeback. They never left. They never left. They're not making a comeback. We are in a situation, that of course, has been augmented by the coronavirus. Now, imagine if instead of talking about it in that negative way, that come back, no come back, they're going on an upward trend, but rather to say, what would have been the cases of this virus or the corona or whatever? Then, had countries cooperated with each other to tame the beast rather than everyone trying to do it alone and the brotherly love, just disappeared, right? Talk about Europe, talk about the United States. Listen, if you start from the premise also that the benefits of close relationships, be they between countries or be they between married partners, they come at a price. There's a price to pay for this. So if you focus on the price and don't focus on the benefits, of course you're going to come back and say, oh, we're going to question the benefits coming from this and that. Look at the cost and cost and cost and cost and all this, right? This is the wrong starting point. Nationalism before Corona was with us. It is with us. It's not making a comeback. It is a part of our daily lives. Now, if you look at the GCC countries, in terms of their support to the less developed countries, whether within the region and outside, they go into direct support through ODA. The UAE is the highest, is the country with the highest ODA contributions across all OECD countries, right? And that's a direct support. Indirect support is providing, employment opportunities within an open door policy that has been the premise and the promise of this land ever since it was created. So the policy of openness in the UAE and beyond, if you look across the spectrum, no one is questioning its wisdom. No one today is saying, well, look where it has gotten us to now. We have imported now a coronavirus. That is not the discussion, right? If you start on that path, then the conclusion, you say, all right, I'm going to close down, go back to my old ways of doing things, right? And then move on, irrespective of what happens across the globe. And this is the wrong premise, my friend. We need more cooperation. I wish, we have the G20 now. It is under Saudi leadership this year. For the first time in the history of the G20, the Minister of Health met. Michael, you remember we made for the first time the Ministers of Trade meet for the first time in the G20 context, and we pushed it through, and we had a nice mission over in Puerto Vallarta, Mexico. But in that, we recreated or we solidified the system, and we try to make sure that the spirit of cooperation reigns supreme. The same is happening, within now, an opportunity for the G20 health ministers to take the realm and say, well, next time a pandemic, virus like this comes along, we all are in it together, to fight it together, and we will have better outcomes than before. That's my premise, and I'm going to be writing on this. I'm going to be researching rather than just giving headlines like I'm doing now.
I think that's great. I look forward to that. And I agree with what basically everyone is saying. However, I'm trying maybe to simulate a bit of problems here. That's my Latin side that tries to do that. I will go to Mike, that I know sometimes responds pretty well to that. And when I say that I was underwhelmed by the decision of the G20 and also the other multilaterals, I'm clearly referring to the position of the United States of stopping the creation of a $500 billion SDR at the IMF and others like that. And also the declaration from the G20 was towards a declaration of not allowing trade, like instead was done in 2008. In 2008, in the crisis of 2008, there was a declaration that was going towards, let's have open borders, let's have open trade. Right now, we don't have that. And of course, the US has a pretty big part in that. Do you see that changing, Mike? And do you see this creating any positive result for the rest of the world and for the United States itself?
That's a big question, obviously. And I just sort of emphasize some of the work that I've been doing on these major trading arrangements in the Asia-Pacific region that have been developing and I think it sort of is exemplary of the problems we have. And that is the United States was negotiating the Trans-Pacific Partnership, was leading the Trans-Pacific Partnership for about 7 years in an agreement that was very much based on a U.S. approach to things, including many U.S. interests. And this included, 12 countries in the Asia-Pacific region, and it was supposed to be a 21st century agreement with new rules that maybe eventually could be taken up globally. And what ended up happening is, the Trump administration on its first full day in office tore up the agreement and left. But interestingly, the other 11 countries went forward with it. And since it's been in effect since December 2018, they haven't all ratified it yet, but it's been moving forward. And there's also another agreement that's Asian countries called the Regional Comprehensive Economic Partnership, which includes, the 10 ASEAN countries, as well as Northeast Asia. So China, Japan, and South Korea are in this, and they don't have any kind of a deep agreement. So I think what you're seeing is, even though you don't have a major trend at the global level towards trying to address these cooperative bottlenecks and these sorts of things, I think clearly at a regional level, you see a desire to do that. And these rules are being built from the bottom up. And we're also seeing this even in Africa, right, with the Pan-African free trade area. Latin America is always a problem, Mario, sorry, but who knows what will happen. So I think that there is, moving forward, that when we think about emerging markets, they are no longer waiting for direction from one country or simply from a few top OECD countries. They are moving on their own. I think that's going to be very positive, because I think eventually that's going to be irresistible for some of the big countries not to come back into that game, if you will. So I think that the problem at the WTO, in part, was due to the fact it was becoming much more democratic. It's very easy to push forward accords if you only have a few economies that need to deal with each other and everybody else is peripheral. But when you have emerging markets that are rising in importance and are major players, then it becomes more complicated. So eventually, hopefully, as it becomes more democratized, it'll also become more mature, so we can actually go back to the table altogether and create the kind of rules that we need that will be relevant for services, for trade, and especially trade in health goods and related. I think we in Europe were very nervous as to what happened. When here in Italy, when Germany at one point was considering export bans on certain things in Europe. I mean, that really gets at its core. But in a positive way, there was a big pushback. And what we need to do is have that pushback also at the global, in my view.
I completely agree also because this opens, of course, all the topic. We don't have the time, unfortunately, to talk about it, but all the topic of global health that will go hand in hand with this. And probably just maybe Dr. Samir, you have a few, just a last question, a last remark to wrap it up. You're mute. You're still mute. This is always, there you go. Nope, yes.
Yes. Thank you very much for everybody who had participated. Thank you very much, Mike and Mr. Hong and Christopher, and of course, Raed Safadi, the dear friend. I think it had been quite a good opportunity to begin something, because I think we rose much more questions than we replied to. Fortunately, future is not yet written. We can do lots. I think everybody of us has lots of questions. I was very much, interested in the fact that globalization is still the trend all over, and regardless of lots of problems created here and there by different nationalistic approaches and reactions. But at the same time, my main concern maybe later would be about what would be the fiscal repercussions of this, what would be the repercussion on what's left of Bretton Woods, of this financial system, because it will definitely, I'm not an economist, but in my perception, this could be very much changing the international climate, the dollar, its position. Of course, now it's in a powerful position, but on the long run, where many players will begin to build their own fate, regardless of the other players, and then to save their neck. And then what would be the final picture, maybe after 3-4 years, not long more, not more than that, but I think there is an acceleration of new dynamics we need to depict maybe later. So thank you very much for everybody, for dear professors, dear colleagues that you participated with us. I hope that we can begin from this kind of workshop to promote and to really approach new questions. We will hope that you will be coming to us and visit us here in Dubai to see the humble work we are doing in this small niche of brainstorming. But still, maybe now there is something knocking the door, is about the future of the energy supply in the world, which is now very hot, and we need to give it our own thoughts. Thank you very much.
Thank you, Dr. Samir, and thank you, everyone. It was really, I think, a terrific panel. I can't wait to see all of you in person. This lockdown is driving me crazy in a bit. So, well, again.
Physical.
Thank you.
Invitation.
Thank you.
Pleasure. Thank you. Thank you.
Thank you for organizing this. Great conversation.
Thank you.
Thanks to all of you.
Take care, everyone.
Right.
Stay safe.
Stay safe. Yeah, I can't wait to be in the lockdown.
Stay safe.
Back to you.